Right, so here I have an example calculating a income tax based upon a single female with no dependents. Okay, so gives some information here on her income and her deductions and other things, and then we'll go through and get this calculation in for her income tax. So single female, no dependents, so she's the only one in the household. Her gross income is $70,000. Adjustments are $2,000. Deductions, she's got $10,000 in mortgage interest, $2,500 in property taxes, and $1,200 in charitable contributions or donations, as I'm calling them. And she has no tax credit for that year. Okay, so with this information, we can go through and find, her AGI, her taxable income, the tax calculation, and the income tax. We can find all this information. So we're going to start out with the AGI, and the AGI, we'll just go ahead and run these up here, is her income, her gross income, which is $70,000, minus her adjustments, which are $2,000, and that equals $68,000. Okay, so that's her adjusted gross income. Now, the taxable income is going to be this AGI minus her exemptions and deductions. Okay, now the exemptions are found based upon the number of dependents. Now, she has no dependents, but she still has to count herself, so that's one person. Now, in the table for the marginal income, marginal tax rates, the number of, or the amount per exemption is listed in there at $4,050. And so we're going to put that in. So it's going to be the 68,000 minus the 4,050 and the deductions. Now she has a choice of either taking the standard deduction, which in her case is $6,300 according to the table, or she can take her itemized deduction. Itemized deduction is from this information here. Whichever one is bigger is the one she wants to actually subtract off. Okay, and so in this case, the itemized deduction will be bigger because right there the $10,000 in mortgage interest is already higher than the $6,300 for her standard deduction. So we're going to go ahead and do the itemized deduction, which together here, 10,000, 2,500, 1,200, that's going to be 13,700, right? So this is 13,700, and so we add those two values together, the two numbers that we're going to be reducing the AGI by. So that is 4050 plus 13700, and that number is 17750. So $17,750 is going to be removed from the 68,000, and we get $50,250. Okay, so that equals $50,250. All right. So that's the taxable income. Now we want to do a tax calculation using that information. So that's $50,250, and then we go to our table. Okay, the table's very, very important here. Now, the way that we read this table, it's a marginal table. Basically, that means that you take percentages off different amounts from that total. Now, kind of think of it in terms of big chunk of money, and you're peeling amounts off and applying percents to different amounts. Okay. I don't have a lot of space with the table showing over there, so maybe I'll take the table down and disappear. Okay. And now, what I'm going to do is I'm going to picture this diagram. This rectangle here represents the total amount of250,000 $250, okay? Now the table says, and I'll pop the table back in, the table says that for the first up to $9,275, 10% is applied, 10% tax rate is applied to that. So basically you take off $9,000, what was that value? $9,275, and you apply a 10% tax to it, okay? Now, the next chunk of money is applied with a 15% tax, okay? So let's say the next chunk of money here is, now I don't know, it's going to be up to $37,650, okay? So this first bar gets us down to $92,775. The next chunk gets us down to $37,650, right? $37,650, yep, okay? Now I almost should do this bottom up, but I'm trying to keep this organized based upon, or consistent with the table, so going top to bottom there with the percents. So the remainder here, this amount, is your 15%. That's what 15% is taken off of, okay? Now what's that value? Well, it's the difference between these two. And if I go and calculate that, $37,650 minus $9,275, I get $28,375. Okay, so that's how much money is applied with a 15% tax rate. Okay, so the first $92,775, that gets a 10% tax rate. The next $28,375 gets a 15% tax rate. Now, because her income, or her taxable income, is greater than $37,650, we have another region here. However, it's not, so that $50,000 is not greater than the $91,150 that's in the next cell. So because it's in between $37,650 and $91,150, checking those values out, this is going to be the last chunk. And so the bottom here is the $50,250 because it doesn't go all the way down to the next, the next limiting value or boundary in the table. And so now I need to figure out what this difference is to get the amount for that chunk. And of course that is $50,250 minus $37,650. And that value is $12,600. Okay, $12,600. And so that remainder gets a 25% tax applied to it. Okay, so now we take our 3 percentages times the corresponding value and add those up, and that gets us our tax calculation. So it's a little bit complicated here, but we can make that happen. Now 10% of $92,775 is going to be $927.50. I'll move the decimal one place to the left. 15% of $28,375, well, that one I'm not doing mentally. 0.15 times 28,375 is $4,256.25, and you can double check these calculations with me. And then down here we've got 0.25 times 12,600, and that should be 3,150. All right, so those are our 3 values, and if I add those 3 values together, that will give me the tax calculation. So I have the taxable income multiplied by the rate from the table in stages, so each of these 3 stages, and then we add them together. So Adding them up, we get 927.5 plus 4256.25 plus 3150. And I am calculating here $8,333.75. Okay. So that's the final amount based upon those three calculations. Now we're not quite done because that is our tax calculation. Now I need the income tax. Well, the income tax is your tax calculation minus tax credits. And we said there are no tax credits, right? And so actually the income tax is going to be that $8,333.75 minus the tax credits, which are 0. And so our final income tax is $8,333.75. Okay? And that should be what she actually has to pay in income tax throughout the year. Now, of course, she's going to have money deducted from her paychecks each week or each time she gets a check. And if the amount that's deducted throughout the year is greater than this, then she'll get a refund of the difference. If it's less than this, then she'll have to pay in the difference at the end of the year, okay? But this is the final amount based upon all these calculations. And all these things are not taken into account for necessarily when you when the money is deducted from your paycheck originally, okay? They don't know, your employer doesn't know all this information ahead of time. So that's why it's important that you get your taxes done and done accurately, because the amount that you pay in is often greater than the amount that you need to pay in, okay?